All right, here we are with part two of chapter four's example. And so in the part one, we did all the journal entries and T tables. And in this video, we're going to do the adjusted trial balance and the financial statements. So in order to really understand where the numbers come from with this part of the video series, for example, for this example, you really need to see the first part, which is in video one, the first part of the example. But hopefully you have all this information. Here's your T-tables. Nothing has changed there. I haven't done anything to them. I just carried them over from the last video. So we're going to start off with the adjusted trial balance first. And this is adjusted because we've already done the adjustment. We only had one, so we didn't do an unadjusted trial balance because there was only one. So we just kind of lumped them into this one. But all I'm going to do is I'm going to list all of my accounts and their respective balance on their proper side, their normal side, whether it be debit or credit. So just to kind of give you an idea, cash, I'm going to start with cash, 48,860. I'm going to put AR. You don't have to because it's zero, but I'm just going to go ahead and put that there. I'm going to do inventory of 8,890. Same thing with land. You don't have to put land there just because it's zero, but you can if you would like. And then we also have AP. AP has a balance of zero, which would normally go on the credit side. You don't have to put that one there. And for the sake of time, I'm just going to go ahead and just put the rest of them on here, and you can kind of follow along, check your work. Hopefully you've done this already. And so once I've got it to this point, then I'm going to go to the debit column and add up all the debit column. And when you do that, you should get a sum of 77,500. And then I'm going to do the same thing for the credit column and hope that it's going to be the same number. And it is. It is 77,500. So we know that our trial balance is good. We know all of our debits and all of our credits equal. That's spot on with what we need to do with the accounting cycle. So that leads us to the next step in the accounting cycle, which is the financial statements. And so we know we start off with the income statement, and to this we're going to put Charlie Company for whatever the year is. And we're going to be doing a multi-step income statement for this one, because we have all the pieces that would make it favorable to use a multi-step income statement. We have COGS, we have non-operating income, or non-operating activities, and so forth. So let's do that. We know in a multi-step income statement, we're going to start off with not just revenues, but operating revenues. So that's the first part. And under that, we're going to start with our sales revenue, our normal day-to-day revenue. And so sales revenue, we have a total of 30,000. And from that, we're going to take away the two pieces that affected sales revenue directly, which are going to be returns and discounts. So let's start with the discounts. So I'll say less sales discount we had a sales discount of 100 that we gave. We also had sales returns that we took back from customers that were 2,000 total. So those are those two T tables. And if I add that up, that's going to give me a sum of 2,100. And if I subtract that 2,100 from the 30,000, that's going to net my sales to be 27,900. So that's my net sales. That's what I ended up ending the year in total sales revenue after the discounts and the returns. All right, from that, I want to take away my cost of goods sold. Remember, this is more informative. I understand that that's an expense, but this is more informative to our investors to say, hey, this is what we truly made on our sales. So net sales minus my COGS of 14,100, that's going to give me a total operating revenue of 13,800. All right, so that takes care of operating revenues. Now let's go into operating expenses. We only have two operating expenses. We have delivery expense, which is 300, and we have selling and admin expense, which is going to be 3,000. We add that up, that's going to give us a total operating, total operating expense of 3,300. And if I subtract my total operating revenue minus my total operating expense, that's going to give me a total operating income of 10,500. So from an investor standpoint, I'm going to look at this and go, okay, that's something I can expect year over year, or at least growth on that, hopefully, year over year. But that's their business. This is their main business model. Now let's look at the non-operating activities, the things that are more or less one-offs. I can't expect them. They're going to happen year over year. I can't plan for them. So we have a few. We have the first one being gain on the sale of land. You remember, land is not my business, so this is just kind of a one-off. I just made some money. So I'm going to put that down here. It's going to be a positive number because it is in revenue coming in is like a revenue. It's a gain. I also have interest expense, and interest expense is considered a non-operating activity because once the note's gone, it's gone. So we have interest expense of $250. And again, that's negative because it's an expense. And so then I'm going to total out my non-operating activities. So I'm going to take the sum of 2,500 plus negative 250. That's going to give me a total non-operating income of 2,250. And if I take my total non-operating income and add it to my total non-operating income, that's going to give me a net income of 12,750. So that's my net income for Charlie Company for this year. Now let's move to the next financial statement, which is going to be our statement of retained earnings. Our retained earnings to begin with, remember we start with our beginning retained earnings, is going to be zero. Why is it zero? It's not supposed to be there in the bottom again. I don't know why that's there. Retained earnings T-table should not be there. But it is zero because this is the first year of this business. So everything starts at zero. We have no beginning balances. So zero plus our net income, which is going to, we just found to be 12,750. That's going to give me an intermediate number of 12,750. Our dividends, we had no dividends, so that's going to be zero. So that means our ending retained earnings is going to be exactly what our net income is, which is 12,750. All right, so now let's go into our balance sheet. Nothing's changing here. We're just going to list out our assets, liabilities, and equity. Assets, we have cash of 48,860. Inventory, we have 8,890. You can put, again, AR and land if you want to, but there's zero. I'm going to leave them out on this one. So our total assets is going to be 57,750. Now let's look at our liabilities. I could put AP there, but it's a zero balance, so I'm just going to only put notes payable because that's the only liability I have a balance in. So 10,000, which means my total liability is going to be 10,000. And finally, equity. Remember, we're only really focusing on two. It's going to be common stock and retained earnings. Our common stock is going to be 35,000. And our retained earnings we just found from our statement of retained earnings, that's going to be 12,750. If I add that, that's going to give me a total equity of 47,750. And if I add that 47,750 to the 10,000 in liabilities, that's going to give me a total liabilities and equity of 57,750. And that matches my total assets, so I know I'm on the right path. Remember, assets has to equal liability and equity, so we know we're good there. All right, so that's the balance sheet. The last thing that we're going to do is our statement of cash flow. And remember, to do the statement of cash flow, we're really only going to focus in on the cash T-table. That's the key to the statement of cash flow. So let's do that. First, we need to go through and write our FAs, OAs, and IAs. So 1-1, the 35,000, that was for common stock. That's going to be FA. 210, that 10,000, that was for the sale from customers when they paid cash. That was OA. 514 and 61, those were both from customers when they paid off their accounts receivable. So those again both are going to be OA. So OA there, OA there. 831, that was the 7,500 from us selling the land that we got cash back in return. So that's going to be IA, investing, dealing with long-term productive assets. And then the 9-1, that 10,000 was from getting the loan from the bank. So remember, investors and creditors deal with FA, so that's going to be FA. On the credit side, we have 10,000. That was for the purchase of inventory, the first purchase of inventory. So that's going to be OA. The 250 was the cost to get that inventory sent to us. So again, that's going to be OA. The 5,000 at 215, that is going to be the purchase of the land. So that is going to be an IA. Then we also had 12,740. That's what we paid for some more inventory. So that would be OA. $300. That was for what was that one for? That was for the delivery expense when we had to sell, or when we had to send the inventory that we sold to our customers. Remember, it's our responsibility. So that was OA. 3,000 was for S&A expenses. That again, normal expense, so that's OA. And then finally, $250. That is for interest expense, and that is going to be OA as well. All right. So now that we have the FAs, IAs, OAs, we can go through and fill out our statement of cash flow. So starting with the first one, remember we always want to start with the best foot forward. We want to start with positive numbers. So we're going to start on the debit side of the cash. So FA, that 35,000, we are going to put as cash received from common stock, 35,000. All right. The next three, so 210 for 10,000, 514 for 9,900, and 61 for 8,000. All of those came from customers. Those were all payments from customers for our inventory. So I'm just going to lump those together and call it cash received from customers of 27.9. All right, the next one, which is 8.3, was IA. That was for the sale of land. So I'll say cash received from sale of land for 7,500. And then finally, FA, the 9.1 FA, that was for the loan that we got from the bank. So I'm going to call it cash received from notes payable under FA for 10,000. All right, that takes care of all of our debits. Now let's look at our credits. The first one, 1.2, that 10,000 was for inventory, but also so was the 1.3 for 250 was dealing with inventory, as well as the 328, 12,740 was for inventory. So all of those together were for inventory. So I'm just going to lump those together because they all deal with the same thing. And I'm going to call that cash payment for inventory. And I'm going to set it negative because, again, this is money coming out. So negative 22,990. All right, the next one would be 215, that 5,000. That was for I. That was when we originally purchased the land. Remember, we purchased the land for 5,000. So we're going to put that in as a cash payment for the purchase of land of negative 5,000. The next one would be 5.5, that 300. That was for the delivery expense. So cash payment for delivery expense of negative 300. We have the 715 entry for the 3,000. That was for S&A expenses. So we will again call it cash payment for S&A expenses of negative 3,000, again under OA. And the last one was the 1231 OA of 250, which was the interest expense. And so we will put that up under OA as cash payment for interest expense. Now, I do want to point out something because maybe it's kind of, hopefully it's not, but maybe it's throwing you for a loop, because if you remember when we did the multi-step income statement, we put interest expense on that under non-operating activity. But here we're putting it under operating activity. And that's just something that's a rule in accounting. But for the purpose of interest expense and interest revenues, those go up under non-operating activities on this income statement. However, they go up under operating activities for the statement of cash flow. So just be mindful of that. All right, so now that we got all of our activities together, we can total those up. The net cash flow from operating activities is going to be 1,360. The net cash flow from IA or investing activities is going to be 2,500. And the net cash flow from financing activities, that is going to be 45,000. If we add those three numbers up, that's going to give me a net increase in cash of 48,860. If we add to it our beginning cash balance, which remember, we're a brand new business, so we have zero in our beginning balances of everything. So if we add 48,860 to zero, we will get an ending cash balance of 48,860, which also happens to be, again, this is a check figure, the ending cash balance for our cash T table. That's what we want. So that's how we do the trial balance as well as all of the financial statements. And in the next video, the last video for this chapter, we will be going over the closings and the post-closing trial balance. So y'all have a good one.